Welcome back, guys. You may notice that things behind me look a little bit different. That is because I have family over right now and I have been officially evicted from my office. Now, because of this, I won't really have time to do my whole weekly playbook like I normally do. Instead, I'm just going to be going over specific plays as I come up with them and trying to get videos out there as fast as possible. So go ahead and at the end of the video, leave me a comment. Let me know how you like this format. It's going to be a little bit shorter than the normal ones. That should be nice for some of you. Just let me know. Let's get into it. Today, we're looking at Palo Alto, a company that provides cybersecurity solutions. None of that really matters though. As traders, all we really care about is they have earnings tomorrow, and that means volatility. So let's get into the analysis. Prior to the beer flu, although the trend was kind of rocky, the macro for Palo Alto was pretty definitively bullish. During earnings seasons, however, Palo Alto has been all over the place, making it really difficult to determine what's going to happen. About 5 out of 9 times they saw rallies around earnings seasons. The other times were absolute dives. Looking at the most recent earnings of their primary competitor Cisco, we can see that Cisco saw an absolute dive this season. That doesn't necessarily mean that Palo Alto is going to follow, but it's definitely cause for concern for people who are bullish about this company. And even looking back at times where earnings went well for Palo Alto, what we saw was huge anticipatory runs up, followed by pretty flaccid movement. Looking at the put to call ratio, it kind of looks like we're in for more of the same. We don't really have a strong directional put to call ratio. Right now it's sitting between 0.7 and 0.8, meaning we're very slightly on the bullish side. Now, even though the put to call ratio is bullish, I can't really justify a bullish position here. Because when we look back at the historical data, we can see that Palo Alto is subject to these gigantic dives post earnings and almost never see huge rallies post earnings. So as far as the right move here goes, you could go for a put if you wanted to gamble on a dive. I personally think the safer and more profitable play in the long run is going to be a call credit spread. So let's get into where we're going to put that call credit spread. Looking at our probability analysis, we can see there's about a 68% chance that Palo Alto will never see above 284. With that in mind, I think we overall have about an 85% win rate for a call credit spread where we go short on the 285 calls and long on the 290 calls. So the final verdict is a call credit spread at 285 and 290 with an expiration of 8/28 for a $1.32 net credit. And that call credit spread should leave us pretty safe if we see that flaccid upward movement we have seen in the past from Palo Alto. And obviously, we'll be able to capitalize on a post-earnings dive too, which I don't think is as likely as it's been in the past here, just given the put-to-call ratio being slightly bullish. But I do feel like there's going to be downward movement post-earnings just because we've seen such a huge anticipatory run up. That's it for this video. Make sure to subscribe. I'm going to be coming out with similar ones all week since I don't have time to just do a huge weekly playbook. If you're looking for a broker, I use Webull. There's a referral link down below. And make sure to leave me a comment and let me know how you like this format. I might just keep it because it's easier for me to do. Thanks, guys. See you in the next one.